Hello traders, welcome back to the channel. Take a look at this impulse swing move. I have plotted liquidity pools using rectangles. All I want you to do is to determine which are the external and internal range liquidity. Pause the video, take a few seconds and write down your answers in the comment section. Okay, this is the answer. If you have got all of them correctly, congrats. And if you are unable to answer correctly, don't worry, because in this video, we are going to learn exactly that. We will understand in detail what external and internal range liquidity is, and I will try to clear all the doubts you have on this topic. So without further ado, let's get started. Before you learn about anything in the market, you must be familiar with the reason why price movements happen in the market. You could simply say it's because of supply and demand, and you're right. But this is a very vague way of explaining it. You can't really use it to your advantage. Essentially, market price moves because of two main reasons. In fact, price does only two things in the market. It either seeks liquidity or offers fair value. In other words, price looks to sweep the liquidity accumulated near the liquidity pools, or it tries to balance out the inefficiencies or imbalances associated with the fair value gaps or liquidity voids. This is what all market movements come down to. Now, this process, where price moves in search of a liquidity pool, is called draw on liquidity. It is based on the idea that institutions and smart money seek out liquidity to execute their large orders, often leading to price moving towards the external liquidity pools before reversing or continuing its trend. For instance, if there is a buy-side liquidity nearby, price will likely move up to grab this liquidity. Similarly, if there is a sell-side liquidity nearby, price will likely move down to grab this liquidity. So this draw on liquidity will help you understand the directional bias of prices. It lets you anticipate the upcoming movement of prices. It helps you predict where the price is likely to go next. This is where you need the help of external and internal range liquidity. In the previous episode on liquidity pools, I have given you a heads up on the two types of market liquidity. These are the external range liquidity and the internal range liquidity. External range liquidity, or ERL, is the liquidity associated with the major swing highs or lows or the old swing highs or lows. Large pools of unfilled buy and sell orders are accumulated near these areas. Now, when talking about the internal range liquidity, or IRL, some confusions could arise. One group of SMC traders will only consider a fair value gap as an internal range liquidity. Even ICT himself follows the same. There is another group of SMC traders who considers all the possible internal liquidity pools as IRL. These includes regions near equal highs or lows, fair value gaps, order blocks, liquidity voids, etc., which are formed within the external swing highs and swing lows. As a matter of fact, I belong to the second group and I have a very good reason to think so. I will explain the reason shortly. In the meantime, if you have a convincing reason that you could change my belief, the comment box is open for you. Now, let's take a few cases to understand this. In this first scenario, we have a price swing and I have marked the swing high and swing low points. We all know that there is a pool of liquidity available near these external swing points. Precisely, there is buy-side liquidity near the swing high and sell-side liquidity near the swing low. Now, if you observe the price action, you could notice a price imbalance. Clearly, there is a gap between this candle's high and the third candle's low. This is nothing but a fair value gap. I hope you guys already know how to plot a fair value gap. If you don't, I suggest you watch it from the SMC Season 1 playlist. Now, remember what we have learned earlier on the reasons why prices move. It is either to seek liquidity or fill an imbalance. And as you can see, it was exactly what the market did. It retraced back to mitigate the fair value gap. And as a next step, price reversed and moved higher to draw on the buy-side liquidity available near the swing high. You can see how the price accessed the external liquidity pool and continued higher. While rallying higher, the market formed imbalances or fair value gaps. Now, what do you think will happen? Quite obviously, the market has only two options: seek liquidity or offer fair value. Let me mark the new swing high and swing low. Let me also plot the external liquidity pools near these swing points. I will also highlight the fair value gaps. Now, let's see what the market has done. You can observe that the price has retraced back and mitigated the inefficiency associated with the fair value gap, and again it reversed direction and started to move higher to draw on the buy-side liquidity available near the swing high level. Now, you can ask me a few logical questions. Why did the market only draw on the buy-side liquidity, and why did it not sweep the sell-side liquidity? Or why did the price reverse after mitigating the fair value gaps, and why did it not sweep the external liquidity pool near the swing lows? The answer to these questions has to do with the market structure. In this case, we have looked at a bullish market structure. During a bullish market, price is mostly drawn towards the buy-side liquidity pools. Especially during strong bullish market phases, you won't see prices retracing all the way down to sweep the swing lows. In such scenarios, the market would reverse after mitigating the imbalances or fair value gaps. But that doesn't mean it doesn't visit the sell-side liquidity. That's not true. There are multiple occasions where the price will retrace even deeper to draw on the sell-side liquidity and then reverse higher to draw on the buy-side liquidity. We will look at such cases next. Now, consider this swing move. The price is in a bullish trend. I will now mark the external liquidity pools and imbalances. Let's see what the market does. The market retraced lower from the swing high, and then it came down to mitigate the fair value gap. But instead of reacting and reversing from the fair value gap, the price pushed lower. If you observe closely, you will notice that there is an extreme order block available. The price mitigated the order block and then reversed direction and started moving higher to draw on the buy-side liquidity pool. In this scenario, you will notice that even though price came back to fill this imbalance, the market did not respect the fair value gap. Instead, it moved lower to collect the liquidity available in the extreme bullish order block before it reversed higher to seek the buy-side liquidity. Now, take a look at another case. Here also, the market structure is bullish. In this situation, I have already marked the external liquidity pools near the swing highs and lows. I have also highlighted the fair value gap and order block. Let's see what the price does. The market started retracing lower and it filled the imbalance. But instead of reversing from the fair value gap, the price pushed lower. It is hoping to find liquidity elsewhere. It came down to this bullish order block and mitigated it. But it did not stop there. The price pushed below the order block, drawing into the sell-side liquidity available near the swing low. It has swept the sell-side liquidity and then started to reverse and move higher. This is quite evident from the deep rejection wick that went down hunting for liquidity below the lows. The price moved higher again and grabbed the buy-side liquidity available above the swing high. In this scenario, the market grabbed both the sell-side and buy-side liquidity areas. This is the foundation of another important concept named dealing ranges, which we will learn in the upcoming episodes. Now, what did you learn from these three cases? The first and foremost point is that price basically moves from external to internal and then internal to external range liquidity most of the time. So price, after taking the external range liquidity, moves towards the internal range liquidity to balance the fair value gap, and then again price moves to the external range liquidity, and this cycle continues. The second point is that price imbalances like fair value gaps or liquidity voids serve as an incentive for prices to return back and fill these price inefficiencies. They act like magnets, drawing the price towards them. This is why fair value gaps are considered as the most important internal range liquidity area. But this doesn't mean price will always respect these fair value gaps and reverse its direction. This brings us to the third point. There are occasions where price will fill the fair value gap completely or partially and reverse direction. But then there are other scenarios where the market would break past the fair value gap and search for liquidity elsewhere. These could be near order blocks, areas near equal highs or lows, etc. Now, this is the reason why I have stated that I belong to the second group who also considers order blocks, equal highs or lows, etc. as internal range liquidity alongside fair value gaps or liquidity voids. But obviously, having an imbalance like a fair value gap or liquidity void is crucial. Think about it. If internal range liquidity is all about fair value gaps, then what is the purpose of having order blocks in the internal structure? It will be useless, right? I agree that order blocks are high probability decision areas, but considering them as internal range liquidity would do no harm. I hope things are making sense. But do let me know in the comment section your view about this. And finally, there are occasions where price will just run through all the fair value gaps, order blocks, etc. and sweep the external liquidity pool. The market is full of probabilities. And most likely, you have come across such a candle sweeping through the external pool of liquidity and rejecting back and leaving behind a very deep wick. And from there, price might reverse direction and continue with the major trend. But at the end of all this, keep in mind that while trading, our main focus is on the external range liquidity because it lies within the major trend of the market, while the internal range liquidities are taken by the price retracements. So if you are planning to trade using this idea, consider the following. First of all, you need to identify the major market structure in your higher time frame. It could be 15 minutes, 1 hour, or 1 day. Let's assume the market structure is bullish. Next up, you need to ask, where is the most obvious liquidity pool which the market could draw upon or target? For instance, if a major high is untested, price is likely to be drawn towards it. And in case if a large price imbalance exists, the price may fill it before reversing again. The overall idea is to trade in the direction of the liquidity draw until a sweep occurs. So once price sweeps the external liquidity and retraces, look for reversals at order blocks or fair value gaps. You could use candlestick rejection confirmations like pin bars, engulfing candles, etc. to time your trade entries. You could also refine your entries by moving on to your lower time frame charts. I will talk about order block and fair value gap trading strategies in the upcoming seasons. Now, this is all you need to know about external and internal range liquidity. In the next episode, we will see how the market approaches a liquidity pool and manipulates it. Will the prices sweep the liquidity or will it run through it? Stay with us to find out. Meanwhile, if this video was informative, kindly hit the like button so that the YouTube algorithm knows that you are interested in these type of videos. If you have any doubts or suggestions, do mention it in the comment section. Also, share this video with your friends and fellow traders. And if you're new to this channel or you have not yet subscribed, please make sure to subscribe to help us complete the 1 million goal by the end of 2025. I will see you guys in the next episode. Till then, bye.